Welcome to the Techno Fundamental Report for May the 15th. Let's take a look at the macroeconomic picture here. This is a graph of the delinquency rate on consumer loans and all commercial banks. And you can see here that the delinquencies have picked up a little bit, but nothing abnormal, nothing recession looking. If you look at the household debt service payments as a percent of disposable personal income, yes, it's starting to show some deterioration, but nothing really serious. We're continuing to see basically a very strong economy, and the real strength is in projected earnings growth. Because if we look at this graph here, this is expected earnings growth by sector for the next 12 months. And also, if you pause your video player and read this commentary, it's basically saying with 72% of the companies reporting this most recent quarter, the index is showing a year-over-year earnings growth rate of about 12.8%, nothing to sneeze at. So basically, corporate earnings look good, and it's interesting to kind of dissect this a little bit. Tech is projected to grow 18.1%, whereas energy is expected to be flat. So the S&P is estimated to be 10.9. So it's mainly tech, healthcare, commercial services, and industrials that are going to have the strongest earnings growth. So we also want to talk about the breadth trust. This is the Zweig breadth trust. Now, what's interesting about this particular indicator is Zweig went back to 1940 and found that there were approximately 14 times that the signal was given, and every single time, 12 months later, the market was higher on an average of around 23-24%. And you can see it here more clearly. So in other words, the breadth thrust indicator is sometimes known as the Zweig breadth indicator. Now, he wrote a book about this, and basically it says there's been 14 of these things since 1945. The average gain following each of these trusts was 24.6% in an average time frame of 11 months. So it also points out that bull markets start with these breadth trusts. So you can kind of see here in this table, we're looking at 12 months out, 6 months, 3 months, 1 month, and 100% of the time it was positive. So hopefully we're in good shape here. I wanted to mention real quickly what's going on with real estate right now, because I think I can make a couple of points. One, I have a good friend that actually owns a condominium where they have to commingle their assets in the form of it's where you have the membership of the condo. And basically what's happening is that they're not keeping these things up, and as a result, Fannie Mae is no longer lending money on many of these condominiums because they're not taking care of things. So when you commingle with other people, even with a mutual fund, you can see it's sometimes you just don't know what's going on behind the scenes. But anyway, let's take a look at the market and see what's going on here. We're continuing to see some very good news here. We're above the 200-day moving average, and we're starting to trend, which is incredibly positive. We've gotten follow-through days. We're now above the 50-day. 50-day is starting to flatten out. The 21-day has crossed above the 50-day. Actually, technically speaking, this is what you're looking for. Same thing with the S&P 500. You can see that we're above that 200-day, and we're starting to trend. And the 200-day is just so important because it just basically is a rule that I have that this is risk on and this is risk off. So we're moving more into more of a time where maybe we should be more aggressive. And we'll talk about the aggression index right here. You can see here with the aggression index where we're doing a ratio of the NASDAQ, meaning tech stocks, compared to consumer staples. You can see we were in trouble most of the year so far. And then we've crossed back above the moving averages, and what we really want to see here is where the lower moving average, which is the blue line, crosses above the red and then starts to trend. So far, that's happening. So kind of good news here. And the other good news is interest rates really are not getting out of hand here. They've climbed up a little bit because we got down to some really low levels here. What happens is that when you get a real difficult stock market, people dump their stocks and they buy bonds, which runs the interest rate down. So as we can see here, confidence is starting to come into the bond market. On the volatility index, the VIX, we got that major reading of a spike above 50, then down below 30. Now we're down into the area of around 18, 19, which is very normal. So it really looks like volatility is starting to stabilize here. Oil continues in a downtrend. We're getting somewhat of a bounce here, but the price of oil is now around 63, 64. We did get down below 60, but it does look like oil could be in the early stages of a recovery, but I would wait. It's still in a downtrend. Now remember, a downtrend is high, low, lower low, so forth. So it's in a downtrend. Other good news is the number of new lows on the New York Stock Exchange have really dried up here. We've gone an extensive period of time here below 40. So the number of new lows, which means that the sellers have dried up. There's just not as much selling going on that was actually happening back here, around April the 7th. April the 7th was the tough day. Now, we also note that gold, it looks like it put in a double top here and is breaking down below support. And again, this is a risk-off defensive type of asset that when people get scared and worried, like we've been talking about, they'll buy gold, they'll buy toothpaste stocks, they'll do all kinds of things to avoid growth stocks. So when this reverses and starts heading down, it's telling you that maybe growth stocks are starting to improve. I think that's the case. We're getting quite bullish. We've been doing some buying. So if you have any questions, please let me know.